All right, thanks for that, Jayesh. Ashwani Bhatia also joining us now this morning from SBI Mutual Fund. Ashwani, one of the questions we've been asking is at what stage we might start to see investors spooked enough to relook or redeem those SIPs. Are you starting to feel that pressure yet? What's the latest on that front?
Well, SIPs are holding up. We haven't seen any requests for, stopping the SIPs. In fact, we are telling our investors that this is the right time to be in the market. And finally, look, what is SIP? SIP is a product that averages out your investments over a period of time. So if you've been investing over the last 2, 3, or 5 years, at this time, you should stay invested because you get more units. And, we know that whatever crisis have happened in the past, whenever the markets have gone or corrected more than 20%, over the next 6 or 7 months, we've always had a decent recovery. So I think the SIP investors so far have kept faith. We haven't seen any redemption so far. So what we are telling our investors is that, look, your losses could be notional, possibly, but don't make them your actual losses. Don't make them cash losses. So I think they're still with us.
Okay, so in terms of the overall flow picture currently, just assess that for us. Are you finding that people are willing to look in at lower levels right now? Are you still seeing some pressure on the back of foreign flows? Really just what's the overall picture shaping up to be like?
So the flows haven't ebbed. They may have come down a little bit. It's natural to be a little cautious at this stage. But what we are telling our customers, and these are all long-term players again, that if they are sitting on some amount of cash, they should use it to enter at this time. Of course, they have sold a big chunk, both in debt and equity in the last 1 month. In March, in both debt and equity, they sold in excess of $7 billion each. But again, there's a limit to which they can sell in the market. So I don't think there's going to be much appetite. The volumes will actually dry up if they keep on selling. So there are people looking for opportunities. To my mind, this is a good time to also average out your investments at this point of time.
Morning, Ashwani. Nikunj Dalmi also joining in. I know the answer, but I'm asking this question for the benefit of our viewers. I have a list of SIPs without getting into the funds and the AMCs they represent, where 10-year returns have become negative or they are in the range of 2 to 3%. So someone who's, let's say, investing in SIPs, the dilemma is that अगर मैंने real estate लिया last 10 साल में, I did not make money, but I did not lose money. If I bought stock markets, I went through an emotional volatility in my mind because of a lot of local and global events, and after digesting that emotional and event volatility, I'm still standing in the same space. So am I not better off buying, let's say, a gold or a real estate where I don't have to go through emotional volatility and my returns are nothing great in equities?
So my answer would be more or less the same. If you've been doing SIPs, if you've kept the faith, for 10 years or for 12 years or 5 years, whatever the time period or time frame is, this perhaps then would be a time to do a bit of lump sum. I know the correction has been significant. It is quite deep. In some of the schemes, it is more so. But if you've kept the faith, this is the time to have more faith.
Being a devil's advocate, that's not what we represent at ET now, but I hope where I'm coming from. Since we are comparing global corrections and this correction with 2008 or 2011 correction, when a bear market starts, it could last for a couple of years. It's not going to get over in couple of months or couple of weeks. So if indeed this is a bear market, both in terms of percentage and in terms of time, perhaps some would argue that it could last for a couple of years. If indeed we are in a bear market, does it make sense to stay committed to SIPs?
I think there's a difference of opinion here. Over the long run, I mean, so what? If winter has come, is spring far behind? I mean, you may say that I am a diehard optimist or something like that. But the point again is very clear. You know, you look at any cycle. I think the longest bear market that we have got in the recent past, if I'm not mistaken, was between 2000 and 2003. And there it was in a range, the Sensex at that time was, I think, between 2,900 and 3,200. And the jump that you got after that, from around 2003, it was at, I think, 32 or 3,300. And from there, you came down to 44. I'm not even suggesting that from 44, you're going to hit a number of 200,000 or so. All that I'm saying that this disruption has been sudden, has been very strong, but we will actually get over it within the next 3 to 6 months. The government has acted. Look at the actions that Reserve Bank has taken. Once we are out of this lockdown, and market is expecting that within the next 10 days or so, there's a partial removal of the lockdown, things will fall into place. So, I mean, I don't want to scare customers to tell them that this is going to last for 2 years or 3 years. The general experience over the last 16 to 17 years is that these bear markets don't go beyond 6 months.
Let's talk about the operational things. Now that there are new timing and now new timing windows for mutual funds, how does it change? How does it change life for anybody?
It doesn't. So instead of for the liquid schemes, instead of getting in your papers by 1:30, they have to do it till 12:30, and all other schemes they've got to put in their requests by 1 o'clock. The system, to my mind, has become more efficient. You know, all the technology is working very well. So we had our first day yesterday, and I think we did pretty well. Customers have also got used to it in very quick time. So this is a short-term measure. It's only from the 7th to the 17th. Hopefully things will be back to normal from the 20th onwards.
Ashwani, we'll leave it there. Thanks so much for joining us this morning and taking us through your views, saying perhaps it's a good time to average out your holdings and doesn't see this bear market last more than about 6 months. That's the view coming in from him. And that